Hi everyone, welcome to today's webinar with me, Fawad Razakzada, market analyst with Think Markets. Also in the room will be my colleague Victor, who is going to be joining us any minute now. And today we'll be presenting the non-farm payrolls webinar, and hopefully you'll be able to learn something useful from us. So this webinar is divided into two parts. First, we will discuss some pre-non-farm payrolls indicators to try and come up with a rough idea in terms of how the headline jobs number may look like and how this will impact the markets. The second part will be all about technical analysis of a few major currency pairs, gold and indices, in order to provide some actionable trade ideas after the jobs report is published. And obviously, as this webinar is live, don't forget to ask us questions in the chat box or in the questions window. And we will be more than happy to talk about any particular market you guys are interested in. But please keep it a bit focused to this jobs report. And if you want to ask us questions more specific about any other markets that are not kind of linked to this jobs report, then please hold back until Tuesday's live analysis webinars, which happens, as I mentioned, every Tuesday. Okay, so before we begin, I want you to read the risk warning and the disclaimer, because this is really important. So these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. Okay. So I think my colleague Victor has now joined. How are you, Victor? Are you okay? Are you in the room?
Yeah, I'm in the room. Very good. Very anxiously looking into the number. We have a huge consensus expectation for this non-farm payroll report.
Absolutely.
And we might see a number that is completely mind-blowing. So
yeah.
Let's see.
Yeah, we will share the expectations in the next slide. But in this slide, obviously, just to give you guys a idea of the webinar, I've already mentioned what's going to happen in this webinar. So let's just skip through this. Before we give you the important numbers, just a quick reminder why the jobs report is so important, and I'm sure most of you guys know, but for some of you who are new to trading or new in the markets and want to know why everyone looks forward to this jobs report, is because traditionally it has been one of the most eagerly anticipated macro events for the markets. This is because one of the Fed's mandates is to maximize employment. The other obviously being to keep inflation around the 2% average target. So when employment is really strong and the economy is doing well, and all else being equal, the Fed is expected to maintain a contractionary monetary policy stance. That is, it would be looking to raise interest rates so that inflation does not overcook. So obviously over the past several months, economic data in the US has improved markedly, and the only thing missing is inflation, like in wage inflation, right? So far, the Fed thinks that inflation in the US is going to be transitory because of short-term factors. It does not expect inflation to remain high, and that's why several Fed officials have come out this week saying that they will not be tapering QE or raising interest rates yet. However, there's been so much inflationary pressures building in the economy. We've seen big moves in the commodity prices that I'm talking about soft commodities here: corn, coffee, you name it. Everything has been going up, and all of that
is reminding me a little bit about 2008 when Ben Bernanke at the time was saying, the Fed chair at the time, he was saying that the problems in the subprime mortgage market are contained to it. So now they're saying the inflation is going to be transitory.
Yeah.
So this doesn't it doesn't look good when you see inflation rising its ugly head all across the board. These comments are sometimes taken with a grain of salt by the market.
Indeed. It's a big risk, facing investors in the months and years ahead. When commodity prices rise as they have been, what it does is it raises input costs, right? Input costs for manufacturers and producers. With margins being so tight, eventually these raised input costs will have to be passed on to the consumer in one way or the other. So eventually inflation is going to rise, I think, and central banks will have no choice but to tighten their belts. Actually, there's less need now for monetary policy to remain this loose, because the global economy is recovering really strongly, especially China, the US, UK is doing really well. And now with the vaccines being rolled out across the Eurozone, things are hopefully improving over there as well. So against this backdrop, you'd have to expect that monetary policy globally will have to be tightened in the months ahead, possibly towards the latter parts of this year, sooner than what many central bank heads have suggested. So that's a key risk to keep an eye on, and that's why the jobs report is really important, because it gives you an idea, or it gives the Fed an idea how the economy is doing in terms of jobs. And as I mentioned, one of their mandates is to maximize employment, and if employment is going to rise as much as 1 million, which is what's expected, then that would be really good news, right? Last month, there was 926,000, almost 1 million last time as well. So these sort of numbers are really good. It shows that the economy, the world's largest economy, is recovering really well from the pandemic, and that things will get even better with the development or the deployment of vaccines. Meanwhile, the unemployment rate is expected to fall noticeably to 5.8 from 6% in March. And hourly earnings are expected to be flat. Now, that is an indication of inflation, right? So if wages are going to be higher than expected, then that could cause a bit of a volatility in the markets. So watch out for that. As well as the headline NFP and wages, I think it's also worth watching the participation closely. The Fed has indicated that it wants to see Americans who are in working age to be encouraged to seek employment and, back into the labor force before it thinks about tightening its belt. So watch all those indicators closely. Now then, the key leading NFP indicators that we monitor have been mixed, which may suggest that the expectations may not be met. However, many states have, in the US, they have reopened in April, and companies are eager to make profit ahead of the summer months. So I think we may actually get a number close to expectations this time, and possibly, above expectations, despite some of the pre-NFP leading indicators coming out weaker than expected. For example, the ADP private sector payrolls report came out at 742,000, which is still quite a big number, right? But it was less than expected. It was more than 100,000 less than expected. So that could be a negative sign for the NFP. The other key indicators that we look at is the employment components of the ISM services and manufacturing PMIs. Again, they were mixed. In the services sector, which is the dominant sector, the NFP, the employment component was stronger. It printed 58.8 versus 57.2 in the previous month. whereas in the manufacturing sector, it was considerably weaker than the previous time at 55.1 versus 59.6. Other indicators have been decent. The initial jobless claims fell in the survey week to 566,000 versus 765 in the previous month. And there were a lot less job cuts in the economy than the previous month, which is a positive sign. So overall, a mixed picture from these indicators. But as I mentioned, we may get a positive surprise because the US economy has been reopening and people are looking forward to the summer months.
Just to interrupt you for a little bit, there is a question from Wim Hack to us. He's mentioning that the Federal Reserve Chairman and Janet Yellen, the finance minister in the US, she's the Treasury Secretary, which is basically the equivalence of the finance minister. And they will be commenting later today what new can we expect and should we wait for it. I would say that probably there is nothing new we can expect from them. They've been quite committed to their positions. Yellen keeps talking up the stimulus packages and the effects that those have on the economy. And the Federal Reserve Chairman keeps telling us that we shouldn't worry about inflation, while you're buying less and less groceries every week for the same amount of money. So we don't expect them to really say anything new. We will be focusing on the NFP number.
Yeah, I think they don't normally comment on 1 month's worth of data anyway, or say anything new. So that's another thing to keep in mind if you're referring to this jobs report. Anyway, I hope that answers your question. Thanks, Victor, for that. Now, in terms of the non-farm payrolls trade ideas that we are considering, okay, so obviously if there's 3 scenarios, the NFP comes out really strong. The other scenarios being that the NFP is around expectations, slightly miss or slight beat. And the third scenario is that if it disappoints badly. Now, with expectations running quite high, there is a scope for disappointment if they're not met, right? All right. So I think a small miss shouldn't derail the rally, as it would keep the Goldilocks scenario intact for the stock market. So if expectations are met or surpassed, then growth stocks should be able to rally. Okay. Now, if expectations are trounced, then you should see, value stocks do really, really well. I think, we've seen the Dow break to a new record high. The focus would be on the Dow because it contains many value stocks that should do really well. I think it would take a really, really poor data, like I'm talking about less than 500,000 for the stock markets to drop. So unless that happens, I think the markets are going to remain supported. In terms of the dollar, well, the greenback may rise initially on the back of a strong number. So that's the key thing, okay? But investors have been focused on the growth story of late. So a strong NFP print and a flattish average earnings number will probably send commodity dollars higher, right? Because commodity dollars are sensitive to the global economy. So I'm talking about the Canadian dollar, the Aussie dollar, and the Kiwi, the New Zealand dollar, etc. Oh, by the way, the Canadian dollar will be in focus because around the same time as the US jobs report, we will have the Canadian employment report published as well. And if you're wondering, expectations are for negative 162,000 job gains, meaning analysts or economists are expecting the Canadian economy to have lost 162,000 jobs in the previous month. Okay. Now then, I think a strong number on the headline and a unexpected jump in wages may cause a more positive reaction for the dollar, especially against currencies where inflation is not really a major concern. For example, the Japanese yen and the Swiss franc in Japan, and well, in particular in Japan, they want inflation. They haven't had inflation for many years, right? And they want inflation to rise. So with inflation rising, it's not going to materially change the position of the Bank of Japan. And against that backdrop, you think that the dollar is going to, well, if it's got a chance of coming back really strongly against any currency, it would have to be against the Japanese yen. And in fact, it has, the dollar yen has been pushing higher, while all the other dollar pairs have been dropping. Part of that obviously being due to the ongoing risk rally, causing investors to move out of the safe haven Japanese yen. Anyway, those are the key scenarios. If you're wondering about gold, I think, gold has popped higher over the last few days. I think it's going to rise rapidly if jobs disappoint today. But I don't know if it will be able to rise significantly in the other two scenarios. I think if NFP is in line, I think that will keep gold supported. But if it trounces expectations, then maybe gold is going to drop back after its recent gains. Okay, let's look at live charts now, guys, and look at some key technical levels and so on. And that was my reminder. Let me get rid of that. Okay, so the Dow, first of all, is obviously in focus because, as you can see, it broke to a new record high yesterday, and Dow futures have pushed further higher today. So it's clear blue skies for the Dow. And the next question is, can it get to the next psychological level of 35,000? 35,000. I think it can, because of the strength of the rally. Unless something fundamentally changes, for example, if the Fed chair Powell starts talking about tapering QE, that's going to, I think, cause the stock markets to drop eventually. But for as long as the Fed and the Fed chair and his FOMC colleagues maintain their current dovish stance, that's going to keep stock markets supported, even at these lofty, crazy levels. Yeah. Obviously, the key question is the Nasdaq. Can the Nasdaq rally even if the jobs report causes government bonds to slump and causing yields to rise? Let me just bring the chart of yields. 1 second. So this is the 10-year US. Yields have started to make lower lows and lower highs, but it comes on the back of a strong rally earlier in the year. And today, obviously, the jobs report has the potential to move yields sharply, depending on the outcome of the jobs report. If the jobs report is really strong, I would expect yields to continue to push higher after breaking out of this wedge pattern. And that may hurt growth stocks and technology shares, you would think, because the dividend yield is quite low in the growth for the growth stocks compared to what you would get investing in the government bonds. So if yields rally sharply, that's going to possibly cause the Nasdaq to turn lower. However, if it rises only marginally, then maybe it's not going to have that much of an impact. So you can see that the Nasdaq here, the daily chart, has struggled really in recent past. It fell quite sharply in February, and again at the start of this month. But so far, the important thing is that the bullish trend has held. We haven't seen a lower low yet on the Nasdaq, which means that the technology sector, despite its poor or relatively poor performance of late, continues to remain in a bullish trend. So an ideal scenario for the Nasdaq would be if the jobs report comes out in line with expectations or misses expectations by a little bit. That should keep the Nasdaq supported, I would think. In terms of key levels to watch, well, the Nasdaq formed a double bottom low here, finding support on Tuesday and again on Thursday at this key support area, which was previously resistance. Or point of the origin of the breakout from this consolidation. Tested that area twice and it bounced. Also, it formed what I call a inside bar failure formation here. There was an inside bar candle on Wednesday. The index broke the low of that candle on Thursday, and then it rallied back to climb above the low of the previous day. And once it started to move above that, then it started to move quite nicely higher, and now it's extended those gains. So the next pool of liquidity would be obviously resting above the inside bar candle, where people who had shorted this index will have moved their stops above. So there's going to be a bunch of buy stops or buy stop orders resting above this inside bar candle, which will, in my view, be taken next, or is likely to be taken next, causing the Nasdaq to potentially pop higher, possibly ahead of the jobs report, or maybe even after. But thereafter, I don't know if it's going to continue higher or it's going to turn lower from around this key resistance area, which was formerly support. I'm talking about this level here to this area. Once support, could this level or area turn into resistance? Well, we shall find out. If it doesn't find resistance here and it breaks through this region and closes above this zone, then that would pave the way for a sharp continuation higher. Meanwhile, I was just looking at a few stocks in the US and technology stocks. And yesterday, Apple here, I saw a number of technology companies like Apple form bullish looking candles on the daily charts. Apple here, Amazon, same story. I don't know, Facebook. Sorry, this is Facebook. Nice bullish looking candle on the daily chart. Google, same story. So a number of leading technology companies are making a comeback. Microsoft as well, finding support from this old resistance area here. So things are starting to look positive once again for the technology sector. Tesla as well. I didn't see Tesla, but yeah, close lower, but holding support around this area, and there's that bullish trend line as well.
Probably the only stock that isn't making those.
Yeah.
It doesn't confine to the same pattern as leading technology shares.
No, absolutely.
It's the absolute deer of this stock market rally.
Yeah.
And its performance has defied gravity and expectations.
Yeah.
How long can this persist? Well, we're about to find out soon, I
Yeah,
guess.
look at this weekly chart here. It's been a crazy rally, right? Massive move since 2020. In the space of 1 year, it's gone from like around $100 to $900. Crazy. Traditional markets, and go. I haven't updated these charts. On Tuesday, for those of you who were here, we were looking at the dollar index weekly chart, okay? And this is a scenario I painted that, let me just get this right, okay? On the weekly chart, the dollar index had formed this bullish looking candle, finding support from this area. And I said that I would take this bullish signal with a pinch of salt because it happened just ahead of resistance, which was here.
Yeah.
This area here. And that a break above the candle could trap the bulls. So far, that's how it's turned out to be the case. It moved above last week's high, and now it's rejected. So the next pool of liquidity would be from trapped bulls below previous week's low, which would be at 90.42 in the case of the dollar index. So that's where I think the dollar index may be heading today. Obviously, barring a major rally for the dollar and on the back of really strong non-farm payrolls number.
So what would be that number? Like, what would invalidate your bearish dollar scenario? Like, how strong of a number do we need in order for that?
Yeah. I think it's really tough to say because the only the reason I'm holding back from being more confident about what number that would be is because a very strong number is going to cause commodity dollars to rise, I think, and that may prevent the dollar from really coming back strongly. But obviously, the dollar index is made up more than 50% of it is the euro. So a strong number, maybe 1.5 million, could be the trigger for a strong dollar rally, causing the euro dollar to slump. That could be the number. I don't know, 1.5 million. I think anything less than 1 million is not going to cut it for the dollar. I think we have to look at the NFP number along with the wage inflation, right? So wage inflation is expected to be flat. Now, if you get 1.5 million, for example, with a unexpected rise in wages, that could be the trigger for a strong dollar rally.
Okay, so with that said, do you have any expectation yourself for the number?
For the number, I think I'm leaning towards the consensus this time because although the non-farm payrolls, the leading indicators for non-farm payrolls have been mixed, and some have disappointed badly, like the ADP, which would normally suggest that expectations will not be met. The thing is that in April, the U.S. economy reopened, and ahead of the summer months, hiring is likely to have gathered pace. So I reckon we are going to see around the 1 million mark or thereabouts. I could be wrong, obviously, but that's what I think. What about you, Victor? What's your expectations?
1.5 million.
1.5 million. Wow. Yeah. So somebody's feeling really bullish.
Well, I'm bullish on the number. I don't know if I'm bullish on the dollar
yeah.
at this, but I'm certainly bullish on the number.
Yeah. Meanwhile, talking technicals again, I've put a line here that the short-term bias will turn bullish above this level. The reason I've selected that particular level at 91.42 is because that was the last high made prior to the index making lower lows. So if that level breaks, obviously it corresponds with this area as well. I think that would be a positive outcome for the dollar index, meaning the euro dollar could go down if that were to happen. Speaking of the the euro dollar, so far it's still looking quite constructive, all told, right? So the key level to watch is this psychologically important level at 120, right here, which has been pivotal in recent past. Okay, so in August of last year, it was a strong resistance level before it gave way in November of that year. The euro dollar came down to test this level here in February, bounced, then it broke below it in March, and then it found some resistance ahead of it later in the month before storming back above it. And since then, it has held above the 120 key psychological level. So the invalidation level from a bullish point of view in the short term would be if we go back below 120 and close below it, right? So specifically, a close below this low, which was at 1993, would be deemed bearish on a daily closing basis. And in terms of support, the high of this doji candle is at 120.26. Could be a nice level to look for potential bounce on the daily. I'm not sure if it will get there if the jobs disappoint or comes in line with expectations. You'd have to zoom in on the hourly time frame. And let me just do that now. Yeah, on the hourly time frame, the euro dollar has already broken above some key support levels. How do I disable this? Yeah, this is a nice support, which was resistance. Call that 120.70-ish. Doesn't have to be exact, right? So on the hourly, you can see rates tested this level from underneath, got rejected here, before it finally went through it. Now it's testing it from up above, and it could bounce here, leading to more gains ahead of the jobs report. So that's going to be a pivotal level to watch during the or when the jobs report is published. Because if we go below, that could be an early indication that euro dollar bulls could be in trouble. Watch out for the cable, guys. The cable has been coiling. It hasn't really rallied as you would expect with the UK economy opening up.
You know, there is a nuance here that might be playing a role.
Yeah.
We got some elections.
Yeah. Local elections.
Yeah, local elections in Scotland. The fear is that Scotland could once again organize a referendum to get out of the UK.
Yeah. Yeah, there's been a bit of talk about that. But I doubt the government, the UK government, will allow it. Like how they didn't allow a second referendum on the EU membership, right? They're not going to accept another one.
Yeah.
It's going to be really, really difficult for the Scottish Parliament to pass another or call for a second Scottish independence referendum. So yeah, like that's the one of the factors weighing on the pound in recent times. But I personally don't think it's going to be anything significant.
Yeah.
But anyway, yeah, watch out for the cable, because if it does break through this consolidation formation, it's going to take out the 140 handle, right? It's been testing that level on numerous occasions, and it's been rejected every time. But the pressure is building. I think it's gearing up for an eventual breakout, and that the motion could start today after the jobs reports out of the way. Obviously, the key risk is that we are reading this wrong. If it moves below 138 and holds below that level, then you'd have to kind of drop your bullish views on the cable, at least in the short-term outlook anyway. So that's my kind of line in the sand, the 138 handle. The dollar yen I mentioned in the webinar, it's holding inside this zone between 109 to 109.35. Previously, this area was support and resistance. Now, you've seen the dollar being really weak against other currencies. Let me just show you, for example. Look at the dollar CAD. The dollar CAD, previously, I was waiting for the dollar CAD to break through this key resistance zone before I turned bullish. It didn't break through that. So that scenario is out of the way. And instead, resistance held because the Bank of Canada turned hawkish, and they say that they will be tapering QE purchases, the first major central bank to do so. And so the dollar CAD has reclaimed this broken trend line from March. And as a result of that, the trend has remained quite bearish on this pair. So you can see the dollar has really struggled against the Canadian dollar. Sorry, the US dollar has struggled. The Aussie dollar as well, holding near recent highs. This head and shoulders formation looks like it's going to be a trap for the sellers, because if this was indeed the right shoulder area, it should have dropped really sharply by now. It hasn't. So I think what's going to happen, in my view, is going to take out this area, bounce from here, and then head above this previous high. So the Aussie is going to be very important to watch today, because whichever scenario you look at, it's going to be I think it's going to be positive for the Aussie. If we get a jobs number that's going to be slightly above expectations, I don't think that's going to cause the US dollar to make a massive comeback. It will keep the Goldilocks scenario for risk assets. Now, the Aussie dollar is a key risk asset, so it may benefit from a slightly stronger US jobs data. If the US jobs data is poor, then the dollar could drop, the US dollar could drop, and that in turn could be supporting the Aussie dollar. So the risks are skewed to the upside for the Aussie dollar, in my view. Same with the Kiwi, head and shoulders. Before it had broken this long-term bullish trend line, it went into a period of not consolidation. It went into this bearish channel. It has subsequently broken out of this, and it's now testing the right shoulder area, very similar to the Aussie.
We have a question from H.H. Hassan about the Canadian dollar.
Okay.
It's going to be very difficult to tell you, like, where is the US dollar Canadian dollar going. Yeah. Like, as Fawad mentioned, we got 2 jobs report, not 1, affecting this pair.
Yeah.
The Canadian dollar is nearing a key monthly chart level, which is from 2017 at 2082. So
2060.
2060, yeah, sorry. To 2061, that's a key level that is likely going to serve as a magnet, attracting
Absolutely.
price that gets there, tests it, and then after the test, we'll see what happens. But while this really major level is so near, the market is likely to visit it. So whether it will be able to break through, I don't know. The move in the Canadian dollar pair has been quite relentless. We've seen the dollar fall from 146 to 120, 175 as of right now.
Yeah.
Maybe
so
that will pause.
Yeah, I tend to agree with what you said. When price is usually very close to a key swing low or a key swing high, it usually takes it out, right? Because people who have been calling for a dollar CAD bottom will have been trapped in this bearish trend. And some of those guys will have placed their stops below a key swing low, because that's what you've been taught to do, right? Place your stops above or below levels where if price were to get there, your analysis is going to be wrong. So a lot of stops will be resting from trap bulls below this level here, the September 2017 level at 126.60-ish. And given that the psychologically important 120 handle comes in very close by, a very likely scenario in my view is that the trend will continue lower. It will take out the black line and then test the psychologically important 120 handle. And that's where we may see a rebound for the Canadian dollar. Even so, I would like to see something like this happen. So for price to break through it, then another attempt to go below, but a failure to take out the previous low. Then what I want to see is a sharp rally to take us above a short-term high like this. Therefore, if that happens, we will have our first higher high in place and a false breakout scenario at around a key psychologically important level. Then what you could do is look to buy the dips. If you're looking to trade the dollar CAD, that's the most likely scenario in my view of how the dollar CAD may bottom out. I could be wrong, but it doesn't hurt to prepare for such a scenario, right? So are there any other questions, guys? We are about 12 minutes over time. If you have any questions, now is your chance. While you guys provide any questions you have, I'll just look at the chart of gold very quickly for you guys. Gold has stormed back to life in the last few weeks. It met its ABCD objective at the 38.2 Fibonacci retrace against its all-time high. So remember, the 38.2 Fib is a shallow retracement. Although gold dropped really sharply from its highs from last summer, in the grander scheme of things, in percentage terms, the retracement has been quite shallow. So it's bounced from the 38.2 Fib. And if you look at the daily chart, you can see that there was also a 61.8 Fibonacci retrace. Gold loves the 61.8 Fibonacci retrace for whatever reason, okay? So that retracement has been taken from the March 2020 low to the high that was formed later in the year. It formed a double bottom here. Also finding support was the pandemic high, or the pre-pandemic high, which was this level here. See this high right there? That was previously resistance before the pandemic hit. When the global economy went into a sharp lockdown, gold started to bounce back and it rallied really sharply. Now, the key inflection point was around this area here, right? So that's where it's kind of turned around from, which is quite a bullish sign insofar as the longer term price action of gold is concerned. Now, recently, it has broken above this high here, and this reclaimed the support at 1765, which was tested a couple of times before breaking down. That level has been reclaimed. That level has been reclaimed, and sorry, my daughter just came in the room. She's going to nursery. That level has been reclaimed, and price has also broken out of this box, this consolidation zone, very cleanly yesterday. So the path of least resistance for gold is to the upside. And from here, it could be heading to the 200-day moving average, which is also where we have the bearish trend line come into place. So the bearish trend line is derived from connecting the previous two highs. It's a potential resistance zone, and there's
the 200-day moving average.
Yeah. So it's around 1850 resistance, right? So that's the sort of area I think gold is going to head towards in the short term outlook. If it breaks below this green box, that would be bearish. Specifically, the line in the sand for me is this level right here. So I'm going to call that invalidation level, right? 1756 is the invalidation level, because if that level breaks, we will have created a lower low of the price attempted a breakout stage. That would be really bearish if that level breaks. All right, Victor, do you have anything else to add?
No, not at this point. I would caution traders who interpret a very high number as bullish for stocks.
Yeah.
Because we might actually see a risk of sentiment if the number is too good. So So that could actually impact commodity dollars and well, meaning Australian dollar, Kiwi dollar, and Canadian dollar, and the stock market to the down. But yeah, that's pretty much it. If you don't have any questions, I feel like we could end it here. There is one more from Hassan about the euro dollar. I think we discussed the euro dollar already. No, like we had.
we did discuss the euro dollar, but just to go back very quickly on the euro dollar, we are bullish, but not as strongly bullish as other. Well, you're not bullish, I know that. We're bullish for as long as, well, I'm bullish for as long as that 120 level holds. If that breaks, then on a daily closing basis, then yeah, I'm no longer bullish on this as well.
Yeah, the figure, I mean, the depending on the number, as we said, a very, very high number might not be priced in. So
yeah,
we could see
absolutely, yeah. So that could be a key risk, key surprise.
A test of 120, but that's just a hypothetical scenario.
Yeah. So there you have it, guys. Thank you so much for joining us. I hope you have all learned something new. If you haven't, you're going to learn something new in the future webinars. For those of you who have watched this online on YouTube or elsewhere, and you liked the webinar, please make sure you like and comment, as that will encourage us to produce more content like this. Also, if you want to join us live next time, you can do so by going to our website, Think Markets. Go to Market Analysis, click on live webinars. Here you will see a list of upcoming webinars with myself and my colleague Victor. Or if you live in Australia, we have Carl, another analyst that does webinars. So yeah, we have lots of webinars. We have the non-farm payrolls preview webinar, which happens like today every month on the day that the jobs report is published. In addition to that, we have the live market analysis, which happens every Tuesday, 11:30 London time. Now, the live market analysis is made for traders, right? So if you love watching the charts, you like us talking about levels, make sure you tune into that one. Yeah. And the next one is going to be, well, this is not in order because there's a problem with the website, but the next one is going to be on Tuesday, the 11th, 11:30 London time. Okay. Make sure to join us for that. Take care, guys.
Bye-bye.